the successful investors invest long, and they do their due diligence on their companies that they invest in.
Yeah.
Yeah. The other day I did see an option trader who put a bid on who bought a call option that had what Tesla at $700 by 2021, September 2021 or something like that. And in February, when Tesla hit like 900, this guy made like hundreds of thousands of dollars with that option call.
Yeah.
And I was like, damn, that's a one lucky guy. That's all I can say. I mean, he put in what 20 grand for that option?
Damn.
So
Yeah,
that's 20 grand or nothing. Or that's not what it is. Whatever the gain you could see from the option call, but your risk is $20,000, right? Going to zero.
Mm.
Yeah.
Yeah,
That's what I mean.
if you're the purchaser of a call,
Yeah.
then it's whatever you paid for the call is your risk.
Yeah.
Which most calls that you purchase go to zero, or most calls that exist go to $0. That's what happens when the expiration time comes, unless the condition actually exists.
Yeah.
Now, when the condition does exist, anything that was, on the right side of the strike price could have outsized gains, and that's what people that now that's the only problem is when you are an options trader. If you're just trading the underlying options, you're not an investor. That you're a speculator.
You're a
That is
speculator.
and this is a market that most people are speculators in.
Yeah.
And so what it's going to do, it's going to put, outsized risks, or expose people to outsized risks as a result of their behaviors. And
in fact,
that's
if you look at indexes, let's take a look at this S&P 500 real quick. I think it was about a week ago when they started saying that the short squeeze is over. A week ago or 2 weeks ago, and that's like this chart right here, like this huge rebound right here. Of course, it has people. It has a lot more people, I'm sure, that buys the dip and go for long, but it's also in part affected by short squeeze, like low trading volume, but rising price. And so those are the people who bet against American economy or the Fed, what Fed was going to do, or the effect of what they're going to do. Just selling their positions early enough that they can minimize their loss. And after that, it's actually been flat since April 17th. It seems like. So that's the
that's
the
I think we
story.
had talked about that before as short squeeze being part of the potential rebound. And we had saw the initial rebound, and then there's kind of like an additional rebound there. Yeah, that could be absolutely right.
Yeah.
Where it goes from here is do we reach kind of psychological levels, thresholds in the valuation of the stock market where people are ready to say, yep, this is the real recovery, we're ready to get in. Everybody pile in? Or has everybody that wanted to really pile in already gotten in, and now are we just kind of tentatively seeing still what's going on?
Everyone's looking at the timing. Everyone's like, oh shit, when is this gonna drop?
So
I'm just waiting.
Now it doesn't mean that it can't continue to go up. It just goes up. If it does go up, it goes up in the face of most of the economic indicators that say things aren't good right now. And as forward looking as you want to be, there's a lot of problems that haven't been solved. We are assuming way too many things that are going to be resolved in the next few months, or even if you wanted to be forward looking as far as a year. I'd say a year is maybe the timeline where you have a lot of things that have been solved. But in the interim, how, like, aside from the Federal Reserve and other stimulus that is providing the life raft to keep people and businesses afloat, how many casualties, and that's business. So we have real death toll that'll be associated with this, and then we have business casualties that are going to be associated with it.
Yeah.
How many of those are there going to be in that time frame? And then how much recovery is there actually in 1 year? I think a year is actually a reasonable spot to start seeing a return to some earnings for companies that have survived and have reassessed and aligned to new demand with the changing the way that demand has changed as a result of coronavirus's impact on the economy and workplaces and consumer habits. I think you'll see a lot of companies that will actually be successful. The only problem is there's so many companies that don't necessarily have a straightforward path to return and grow those earnings as they had before, and it's going to severely weigh on them. And because it's going to weigh on them, it is going to impact the successful companies. Because
like
they're
Facebook.
more than likely than not doing business in some way. Right?
Like Facebook, like Pandora, like Spotify, like Yelp. All these you look at this is so crazy. Like you look at S&P 500 right here, this chart. And if you look at NASDAQ actually made recovery. It's actually at a point where it has gained like a point or something in 2020. Like this bottom to new peak and this bottom to new peak is like a big difference. And these are all the tech companies that people think that all the workers can work from home. They're benefiting from online retails, online sales, online ads. And so everything is going online. A lot of the companies that are in NASDAQ are healthcare and tech. So like all the money is kind of going towards this index now. And long-time investors, I've read few articles, and long-time investors see that this is no different than bubble.com in a way. Like very short-term bubble.com phase right now, because some of these companies, like we said, like Uber or Lyft, Uber Eats, like they haven't profited a single penny from those businesses, but their valuation is super high. So yeah, they're just and another thing that I read from the Economist magazine is if there is a company who lied about their profits or revenues or earnings, just like Lehman Brothers or two Chinese companies that got caught in a fraud scheme. I think it was one of them was like a coffee company, one of them was a retail company in China. If those fraudulent activities surface during this time, that's going to be really bad. That's going to be really bad for the stock market, just like 2008, but maybe even worse. Yeah.
That's another good point. So like a loss of confidence. if there's an underlying issue, and really this can apply to anything. If there's an underlying issue and it shows up in one area, that risk can be extrapolated to all other areas, right?
Yeah.
One issue with one company that now is like oh shit, this company is impacted in this way. Maybe so everybody seems to be pulling guidance, and that doesn't seem to be punished in the stock market the way that it probably should.
Right.
Which is another red flag, right?
Yeah.
But if there was a deliberate attempt to conceal or hide things other than pulling guidance, because like that I guess is on some level, but to lie essentially about what the impact to your business is, because you're worried as a business. You're trying to do your businessy things and find a way to survive. If that though shows up in the wrong way, then it could be a risk that seems to be then like every company's is a suspect.
Right.
Confidence can erode in a certain way, and
Right.
that same confidence I've seen. So with all of these lending facilities that the Fed has, and there's no solidified terms of what strings are attached to money that is taken from these lending facilities that the Fed has established. It's not clear to businesses what impact or what things that they'll have to concede to take that money. So that is scary to them, and because that isn't being established or isn't being resolved currently, it's if the Fed ended up doing something that looked like it was going to be unattractive to businesses that were taking money in some way, that was unexpected to those businesses, because they're currently probably hoping that all strings attached get removed. No strings attached, free money. That's, I think, what the hope is.
Yeah,
that would be the best case for businesses that are able to, that are eligible to take the money. Would be no strings attached. It would be 100% the best thing for them. Not necessarily the best thing, just the best thing for those businesses. Makes sense. Now, if that, with the forward-looking market, if that isn't the case, then that changes the perspective on investors hoping for that to be the case. Or if the Fed retracts some of the things, if they walk back some of the things that they've been looking to do, then that also hurts confidence of investors on how strong of backstop the Fed is providing for companies in the economy.
Yeah, so it's one thing goes wrong, these investors' confidence is going to swing a lot, and that directly translates to volatility means uncertainty. Uncertainty means there's string or train of events that could happen just down the line. If
there
one thing goes wrong.
So many cracks in so many places that if they open up a little bit, everybody's gonna fall in.
But so far it's been I'm just gonna say, like, it's been super impressive how far this could actually. I mean, it's actually, you know what I'm impressed by? If COVID-19 didn't actually happen, this year would have been like crazy upside in terms of stock market. I feel like, I mean, I know that they downgraded expected earnings and all that stuff, but man, even the year-over-year numbers are pretty damn impressive for a lot of the companies, actually. So yeah, this could have been a hell of a good year, but that's not the case, and there were a lot of gaps starting to happen between like small cap and large cap and mid cap and large cap companies. Same thing with the international small cap, mid cap have been flat since like 2018. Large cap is the only companies that has seen like extreme growth in the last 2 years. By the way, I do I have to mention this. I have this chart pulled up, and I have to share it with you. USO, and I think people know what USO.
Yeah, so all this time, and we had been talking about this, we just didn't put this in any of the videos, but we had been talking about oil, and we just never captured it. And then the craziness that unfolded in oil, I wish we had talked about it, because so you had talked about examples of people that you had seen getting into and risky trades with call options and stuff. I feel like I have stopped a lot of people from getting into bad trades with oil. Everybody that's like, hey, have you seen how oil's going down? It's a low price. I think this is a good opportunity. And I'm like, stay away from the black gold. Just don't touch it. Don't touch it. Dangerous play. Well, and then with a lot of people not understanding, the supply volumes, and then the needs for storage and transportation costs
Mm-hmm.
that ultimately weigh down in a low demand environment, high supply environment.
Mm-hmm.
Then when you have a futures contract execution date or expiry date, and then the oil valuations of that contract go negative because all of the people that were holding it didn't actually intend
Yeah.
to take it, or if they did intend to take it, they assumed that they would have a place that they could
Sell it
to
to, yeah.
store it, or sell it or
Yeah.
store it in
Yeah.
the near term. But all of the places, especially West Texas, intermediate
Yeah.
storage in most of the major producing areas of the Permian Basin were like at capacity. There wasn't anywhere to put the oil. Like
Right.
there just wasn't anywhere to put it, so they had to sell it at a loss. You see these ridiculous stories of negative oil, and
Mm-hmm.
I had kept on saying that we would see single digit oil,
Price.
and
Yeah.
like, so to see it go negative like that, but to realize that it was a contract base was crazy. It was
It was
amazing. I'm
crazy.
glad that I mean, not amazing, it was bad, but I'm
Yeah.
glad that I told people to stay away from it. It's
Yeah.
probably a good thing. And that doesn't mean, so even though it's been rallying, the new, we've got what, May 19th is the next 1 month futures contract expiration date. Now we probably won't see
Mm-hmm.
negative prices because that's what we had seen before. But I think ETFs like this USO, or like in certain indexes that were tracking oil in some way, but
Mm-hmm.
weren't tracking it 100% because they were doing 1 month out contracts in higher
Yeah.
volumes. I think they've panned away from that, so the risk isn't loaded in that first. You don't have a single owners that don't intend to take on the oil. You don't have so many of those owned uh, by these entities, these
Yeah.
indices and stuff like that.
If
So the risk of negative oil is less, but the probably still be like, I don't see demand skyrocketing for oil, even though we've cut production worldwide, but we haven't cut production
small.
enough to meet demand, and we've been filling up the remaining capacity of oil worldwide. In the interim, we were at like 60 or 65% back when we had the negative worldwide capacity full, and that's like you're 100% capacity in some locations, and maybe you have spare capacity in other locations in other countries, but like, and you have places that you wouldn't traditionally store
Mm-hmm.
oil or holding oil, like tankers. Every tanker worldwide turns into just a big storage unit for oil, and then it's not moving oil anywhere, so like
Yeah.
you don't have any way to move oil from one location to another location. So the whole thing, all of those things still exist. I'm sure that there's being capacity added at some rate, but how profitable is that when there's like when you don't know when the price of oil is going to rebound to add capacity, like, because that has some cost. So like there's so many risks still associated with oil.
Yeah.
It seems it's still a trap for a lot of people that are
It's
trying to
trap.
get into it,
Yeah.
because sure, the rebound is there at some point in time, probably, right? There'll
Mm-hmm.
probably be a rebound when you've wiped out a lot of producers of oil. They're just not able to produce anymore. And you actually draw down storage capacities, and demand restores, and maybe that's 12 months out. Maybe you have some small recoveries and declines in between now and then, but you don't actually see a real recovery for probably much longer, 12 months or more. And again, all of the people that are trying to dive into oil, they're not investors in oil. They don't care about owning oil. They're just speculators,
Yeah.
right?
Right.
It goes back to the exact same thing that we were talking about before. So there's only more pain ahead for people. With some people will make gains, but there's probably more pain in oil ahead for people that are speculators. Speculators are going to get crushed in a lot of scenarios
Yeah.
in this market, with
Well.
some people making outsized gains, but
Oh.
that's just how it works.
Will you be able to explain the difference between the price that went negative, like $35, negative $35 per barrel or whatever, and
Right.
versus this ETF USO? Because when people saw that oil price was negative, I mean, the price is negative. How can it go down, right? At some point, it has to come back up, right? So that's
Mhm.
why people went in and searched, how do I buy oil?
How do I buy
The
oil? Yeah.
first search you find is USO, and the week when the oil price went negative, USO index saw $3 billion come in from people. You don't
Oh
know
man.
who. This is from Robinhood stats.
Yeah.
Most likely young investors.
Oh yeah.
Like,
Yeah.
but then, but then USO declined from that point like 50% or so. Like, what's the difference between the price per barrel that we saw and the USO ETF? Do you know how those prices are
I,
marked? Do you know?
yeah. So I'm not 100% sure on how USO does it, but they have probably like buckets of different futures contracts that have different expiration dates
Hmm.
into the future. They were
So
I want
futures
to say that they were
contract is like,
yeah.
I want to buy, $25 per barrel on that date is the
Yeah,
futures.
I want to take delivery
Hmm.
of a physical asset, in this case being oil. I want to take delivery of oil at this future date at this price.
Right.
Uh, that's what futures contract is.
Okay.
And
And then
so when
continue.
you have entities that are they're ETFs or indexes that try to mimic in some way oil prices, depending on what contracts that they own, that is going to determine their valuation, the index valuation. Uh, so you don't actually get into, you're not purchasing the futures contract that was negative, and
Right.
plus, like then you would have to take receipt if you were the actual buyer of that. So like, USO didn't necessarily own all of those future contracts, and then didn't necessarily reflect the negative price and the potential gains back to a normal price, since that scenario just doesn't exist because it was very specifically futures contract for delivery
Hmm.
for May that expired on April 18th or 19th or whatever,
Yeah.
and that was just kind of a specific scenario, and you have a flood of people seeing that, not understanding necessarily what they were getting into, buying oil, which is ultimately still have all the issues that it has, where
That you
price
talked
is going to
about.
decline.
Right.
So you have all of this money going in, but the underlying value of the assets, which is whatever futures contracts, were still not making outsized gains. So like
Right.
you have to, and we're seeing the similar things in other ETFs where there's tons of money flowing in. So like airlines, this is another good
Jets.
example. Jets, yeah, jets.
Jets.
So there's like been $600 million of investments over the last like 2 months into jets, the ETF uh, for a bunch of airlines,
Right.
and yet the value continues to decline. How does
Hmm.
that make sense? Well, it's because it's based off of whatever the underlying assets are, which are airlines, which are not in a good place right now.
No.
So you can funnel a bunch of money in, but it doesn't necessarily matter, especially when you have the underlying vehicle is futures contracts in the case of oil or something like that, and it doesn't. It's a derivative that can change in price way differently than what is intuitive to most people.
Hmm.
So it these are all different traps for retail investors. They're all things that people are going to get into.
Yeah.
They don't understand what they're getting into.
Yeah.
They're going to lose money. Then they're going to get out when
The,
they're at a loss or
yeah.
something, or they're going to ride it down to an even bigger loss because they
Yeah.
don't necessarily understand all of the risks associated with the product that they actually purchased.
Yeah, and I guarantee you, if you look at any recession or depression or stock market significant decline, 20 to 50%, there's always a rebound, and that retail investors' confidence and their cash positions just trim down slowly and slowly and slowly. And so, like, the graph has a big rebound, and then like it goes down further, and then it has a smaller rebound and goes down further, and it has a rebound. It's just until the institutional buyers actually step in and sets the tone at that level that they think is a reasonable. You're gonna see a behavior like this in a market, but you know it'd be really funny. We talk about all of this, and it just goes right back up.
Yeah.
3,000,
Yeah.
3,000 S&P, baby.
Yes, I mean we're kind of biased based off of the things that we're looking at,
Right.
and we also do understand the support that can allow
Yes,
stock market to
we do.
keep going up.
We do.
We see that.
Hmm.
Just don't. We're not buying it.
I don't trust it. That's the thing.
And a lot of it comes down to a lot of the fragility that's being built into the system, into the stock market. There's a lot of fragility there in terms of where the value of a lot of the market is being concentrated.